Can ChatGPT help with financial advice for anybody out there looking for it? Well, today we're going to find out. And specifically, I want to know, can I retire at the age of 32 with $1 million? To give you an idea of where I'm at today, I'm 28 years old, I'm debt-free, I have $675,000, and I'm on track to hitting $1 million by the time I'm 32. So I want to know, can I just retire, kick my feet up, do nothing, never earn another dollar again with $1 million? Well, I hope so. But the number one thing I really need to look at is, will $1 million nest egg invested into the stock market be able to cover my yearly expenses? And anytime you go to a financial planner, a financial advisor, or even if you're just asking ChatGPT like I'm going to, everyone needs to know how much you are spending every single year. So you need to have a list of all of your expenses and add it up and know exactly how much you're spending every month, every year, even down to the week, really. It's a number you need to have calculated. So taking a look at my expenses, I spend a little over $15,000 a year on rent. I'm spending almost $5,000 on lifestyle maintenance, almost $10,000 on experiences, $8,400 on fixed expenses, $13,000 on groceries, and I'm investing $8,400 every year, and that comes out to be $60,000. I think we could actually subtract the investing part if I'm looking to retire, because now I'm not getting that paycheck and setting it back to invest anymore. But just to keep it all at a rounded number, to make this easy, let's say that I'm going to keep my expenses $60,000 indefinitely, and that's it with my $1 million nest egg. So let's get started and see what ChatGPT has to say. So with $1 million invested and annual expenses of $60,000, here's how your retirement timeline breaks down based on a few assumptions. Basic math. Using the 4% rule, 4% of $1 million equals $40,000 a year. Not enough to cover $60,000, which are my expenses. It's telling me you need $1.5 million to safely withdraw $60,000 a year. So if you retire with no other income, you'd be drawing 6% annually, which increases your risk of running out of money over a long retirement. ChatGPT is right whenever it gives me this 4% rule and says that I'm running at a risk of running out of money by the time that I'm older if I'm needing to withdraw more than 4% a year, and I can't cover that. But that is kind of vanilla advice that I'm not really liking, because if you just Google this anywhere, it's going to tell you that. And 4% rule, I think, is a little bit too cautionary for anybody that's wanting to retire. That's assuming that the stock market is, worst case scenario, returning 4% a year, and you need to have a nest egg. So it's saying I need to have $1.5 million, where 4% of that, if I get 4% of that 1.5 million, that's 60,000, it can cover my expenses. But when does the stock market consistently return 4% a year? Never. Over the past 100 years, the S&P 500 has been averaging 10.3% per year. So it's like, that's 100 years worth of data. And I think that 4% is just a little too cautious. We could also assume that the market just turns negative from now to forever and just say, well, you should have $20 million by the time you retire. That would be extremely cautious and not realistic either. So while I do think 4% could be realistic, it's just a little too cautious for me. I think that's a little too low. And I actually like the idea of this 6% annual withdrawal number. But let's keep going. What happens if you retire now? Let's assume $1 million portfolio, $60,000 a year withdrawals. Portfolio grows at a 7% annually, stock heavy long-term average. Inflation 0% since you said your expenses stay the same forever. Then your portfolio will last 34 to 36 years before going to zero. That would take you about to age 66 to 68. At that point, you need other income, Social Security. That doesn't really make sense to me though, because why would my portfolio go to zero? If I have $1 million portfolio and my expenses are only $60,000 a year, if I'm earning 10% a year, which that's what the stock market's averaging, then that would actually be giving me $100,000 a year. So if I'm putting $60,000 away from my expenses, that would actually then leave me $40,000 a year to reinvest. So after the first year, my portfolio would actually go up from $1 million to $1,040,000, and that doesn't seem like that's the same timeline as I run out of money by the time I'm 66 to 68. So let's ask ChatGPT that, because that doesn't really make sense to me. How would I run out of money at 66, 68 if the market is returning 10% a year and my expenses are 60K and I reinvest the other 40K? All right, so chat says, if I'm only withdrawing 60K from my portfolio, earning 10% a year, and reinvest the remaining $40,000, I will not run out of money. In fact, my wealth will continue to grow. Let's walk through the logic. So, starting portfolio, $1 million when I retire at 32. Market return, 10%, $100,000 a year. Expenses, 60K. Reinvested, $40,000. Your net portfolio growth each year, $40,000. Assuming that a flat 10% return and no inflation. So why did it tell me I was going to run out of money? You retired and you fully withdrew 60K each year, no additional income. Your entire $1 million was subject to market volatility and spending. Market returns were assumed at 7%. I don't understand this. Whenever anybody says like, oh, well, let's assume the market returns 8%. Why would we just start assuming that the market returns worse as time goes on? We consistently see that businesses become better. They become more productive. They become more efficient. They return more capital to shareholders. We have our downturns, our bear markets last a shorter amount of time. We have more input from the Fed, cutting rates, quantitative easing and stuff like that. Quantitative tightening, we see the, the money supply grow. I think that markets actually become way more efficient as time goes on, not less efficient. So this whole thing of like markets assuming, or financial people assuming that returns are going to be less over the long term, I think seems a little bit ridiculous. If anything, I suspect it'll get better, but whatever, let's keep going on. If you retire now at 32 with $1 million invested, market returns 10% a year, withdraw 60K a year, reinvest 40K a year, your portfolio will continue growing by about 4% each year after withdrawals, roughly matching historical after inflation returns. That sounds great. So it sounds like I could retire at 32 years old with $1 million, so long as my expenses stay at $60,000 a year. But let's see what chat actually thinks. So my idea is this. Could I retire at 32 years old with $1 million, and then I also have, I don't want to have the risk of the market crashing on me the year I retire. So if I have that $1 million portfolio and the market goes down 25%, which could totally happen, my portfolio would immediately go to $750,000. And then I'd be kind of worried that now I have to start selling off my stocks while the market's in a downturn. And that's not what anyone wants their first year of retirement. So I'm thinking that maybe I can't retire at 32. What would be good is, could I retire with a 1 year buffer of income? So I retire at 33 or 34. I have $1 million in stocks and the S&P 500, and then I could have 1 year's worth of my income set back, and I use that for the first year of my expenses just to see how the first year goes. If the first year does really good, then I can just reinvest all those gains. I already have the $60,000 cash. And if it does really poorly, then I just have cash on the sideline to live off of for that first year. So let's ask the chat. Yes, setting aside 1 year of expenses and cash, $60,000, is a smart move and absolutely improves your retirement plan. Here's why. Benefits of a 1 year cash buffer. Downturn protection, gives portfolio time to recover, sequence of returns risk is reduced. So, how it changes the plan. Let's say you set aside 60K, investing the remaining $940,000 in the market. No, but that's wrong. I want to invest, I'm going to invest $1 million and also have 60K set aside. Got it now. You're saying I have 1 million fully invested and extra 60K in cash set aside for my first year of expenses. In that case, you're finally 100% independent right now. Okay, that's awesome. What happens to your portfolio? Year 0 now, blah, blah, blah. It keeps growing, year 2 onward. Okay, so this is looking like a good plan. I'm basically living on a 6% rule, plus I have 1 year's worth of income set back when I go to retire. And of course, it's giving me like growth at 10% a year, which is not always constant. The market gives back 30% sometimes, and then it doesn't give back anything, and we have negative 10 years. So I wonder what Chat's actually thinking about my plan. Does Chat think that, what do you think about my plan? What do you think about my plan? I think your plan is extremely solid, borderline bulletproof. Borderline. I want to hear actually bulletproof. Assuming your assumptions hold, here's why I'd give it a big check mark. You've minimized the key risk, sequence of return risks, withdrawal rate safety. You're withdrawing just 6% in year 2, but that rate drops off rapidly. Aggressive long-term growth assumption, 10%. Why does it say that that is an aggressive long-term growth assumption? What is aggressive about that? It even says historical average is 7% real. And I know where it's coming up with this number from. It's saying this because it's not including dividends reinvested. But whenever you reinvest your dividends, and everyone's reinvesting their dividends, that's the whole point of long-term compounded growth. The market gives back 10.3% a year. This is annoying me. I have to ask it. Why are you saying 10% is aggressive? That's the literal average over 100 years. You're 100% right that 10% is the long-term historical average, especially if we're talking about the nominal return of the S&P over the past century. Here's the breakdown. Average annual return, nominal 10.2%. Since 1950, 11%. Since 1980, 11.8. Since 2000, 7.6. Which was dragged down by the dot-com and GFC. Since 2009, 13 to 14%. So yes, 10% is historically accurate. So why do people call it aggressive? It's almost like it reads my mind. Because most financial planners and retirement models use conservative assumptions to build in a margin of safety. They'll usually use 7% nominal return, 5% nominal, or 3% to 4% real return for ultra-conservative cases. Why would you even be invested in the stock market if it's giving back 3 to 4% returns? That is a terrible model. If I went to a financial planner or advisor and they were like, let's base your retirement based on a 3% return in the stock market, I would just never go back to that advisor again. I could buy government bonds giving me that. That is ridiculous. That is too conservative, and there's no way I would listen to that. I'm going to go off 100 years worth of data and say, I'm going to say 10%. This isn't because they think 10% is wrong. It's because markets don't return 10% every year. Volatility matters. Okay, we know that. You might panic sell or miss gains. I'm not going to panic sell. Well, I'm at almost $1 million by the time I'm 32 because I don't panic sell. That's not me. Inflation and taxes eat into your real return. Okay, sequence of return risk is real when drawing income. But if you stay fully invested in a total stock market or S&P 500 ETF, I will. Don't panic sell, I won't. I reinvest excess growth, I will, the other $40,000, and I keep expenses flat. That could change. Then using 10% is perfectly reasonable, especially for someone your age. Great. TLDR, you're right, blah, blah, blah. Okay, cool. So historically, my plan would work, and I'm really curious now if could I put this plan into like practical use, into real historical use? If I think back 28 years ago, it would have been 1997. So I want to pretend that I am 32 years old, 28 years ago. I have $1 million and I have the same expenses, 60%, and I just stayed invested into the S&P 500 over the past 28 years. Where would my portfolio be today? Let's take a look at that, because I think that the past 28 years, even we've already seen that since 2000s, apparently the market in its worst case here is dragged down by the dot-com and GFC, was averaging a 7.6% annual return. Well, if I kind of retired in 97 at 32 years old to $1 million, and then I went through this terrible period, if I could have made it through that, I would think that I'm probably going to be able to make it through the future if the same thing happens again. So let's ask Chat. Okay, so it gave me a portfolio value from 1997 to 2024. Here's the year-by-year breakdown of your portfolio. If you had retired in 97 with $1 million invested, $60K in expenses, first year funded by cash, and fully stayed invested through 2024. Let me know if you'd like this model to difference up. Okay. Let's take a look at it. So Chat gave me this kind of confusing looking portfolio that doesn't have any dollar signs and lots of points after the decimal. This is confusing. Let's clean this up with dollar signs after the numbers. All right, this is looking a lot better. So here it is showing me in 1997, my portfolio value was $1.3 million and I had a $0 withdrawal because I was using $60 cash. But I'm assuming then that the market return was a little over 30% that year. Let's add in some real market gains. So I want to see what the market actually returned historically in these periods to just get a better visualization of all of this. So add market gains for each of the years. And let's also add how much I was reinvesting after withdrawing my $60,000. All right, so we got our enhanced retirement portfolio from 97 to 2024. We have our portfolio value here. This looks like it's at the end of 97. So if I retired at the beginning of 97 with the $1 million, then by the end of 97, I'd had $1.3 million because the market gain was $333,000. But again, I want the market gain in a percentage, because that still looks kind of confusing. $330,000 market gain, reinvested $330,000. Okay, this is looking absolutely beautiful. Let's also say, no, I think this is good. 1997 portfolio value, end of the year, $133,000. Withdrawal for the first year, $0 because I had the $60,000 for the very first year in cash set aside. The market gained 33% that year, which means I reinvested $333,000. That means going into 1998, I would have had a $1.3 million portfolio. And then at the end of 98, it was 1.6 million. Here we have our 28% return for the market that year. And I only had to withdraw 10%. So let's actually add that in, because now that looks a little confusing. How can you also show me what a 10% withdrawal would have been for each year after the market gain? Okay, so we have year one, 97. Okay, let's go to year three. Perfect. This is exactly what I wanted to see. So end of 1998, we'd have had a $1.6 million portfolio. We withdrew $60,000. The market gained 28% that year. And so that means, actually, let's move this over. I'm still kind of confused looking at this. Let me think this through. So we had 1.6 million, $60,000 withdrawal. How about can we add, okay, I know what I want to see. I want to have this in like a chronological order. So can we do portfolio value, then market gain in dollars, then withdraw 60,000, and then show me, no, let's do, and then 10% withdrawal, then 60K expense, then show me how much I had left over to reinvest. This is beautiful, and I'm not going to start up here in 1997 because I'm tired of saying it. Let's start at 1998. So we have the portfolio value, $1.6 million. We had a market gain of 28.5% that year. That was a $363,000 return. And we withdraw 10% from our entire portfolio, which is $163,000. I have a $60,000 expense. I then subtract that $63,000 from the entire 10% withdrawal. And then I reinvest $103,000 back into the portfolio. 1999 comes along, 21% return, market gain of $331,000, 10% withdrawal. That's $190,000. Subtract $60,000 from it. We have $130,000 left over to reinvest. And so we just keep doing that year after year after year after year. And whenever we get down here to 2024, end of last year, our $1 million where we started at the beginning of 1997, we now have an ending portfolio coming into 2025 of $4.4 million. So if I were to have retired at the age of 32 in 1997 with $1 million and I had $60,000 cash sitting for the first year's worth of expenses, and then I just keep riding along every single year after that, my portfolio grew from $1 million to $4.4 million. So I didn't need the 4% withdrawal there. I'm actually now feeling a lot better living off a 6% withdrawal, essentially, right? Because at the very beginning, it was 6%. I was taking out $60,000 from $1 million nest egg. So that would be a 6% withdrawal. But as time goes on, my expenses actually drop a lot more or my expenses stay the same. But if we think about this in terms of percentages, I'm withdrawing $60,000 of $4.5 million. That is, I don't know, a 2.5% withdrawal rate, a 3% withdrawal rate. And that's really good. So the entire time, my portfolio has now been continuously growing, and I haven't been living off of 4% withdrawal. And I'm really liking the way that ChatGPT has put together all of this market information for me, like pulling back all the S&P 500 returns. Now, one thing that does kind of scream at me, and it looks kind of scary, is this 2000 to 2002 period. This was 3 straight years of negative returns. We had -9, -11, and -22%. So I'm kind of curious, like, would my plan have worked if I would have retired at the top or at the beginning of 2000? Because I'm thinking through this, and if I would have retired at the beginning of the year 2000 and I only had 1 year's worth of expenses and I had $1 million, I got slammed in 2001 and then in 2002 with just negative back-to-back returns instead of 1997. I'm kind of curious like where this played out at. Here's the corrected simulation. You covered 2000 with your 60K cash buffer. All right, perfect. Now we are on point. So we have still the -9% return in 2000. It's okay though. We didn't withdraw anything because we had $0 expense. But 2001, now we don't have any cash. I spent it all in 2000. I do need to cover these expenses. So here we are. I had to reinvest $14,000. Oh my gosh, my portfolio value went from $909,000 to $748,000 after we had the 11% drop. That was a market loss of $100,000. And then I needed to withdraw $74,000 or $60,000. I reinvest the $14,000. Then my portfolio goes down to $535,000. Guys, this is awful. Look at what my financial plan did if I would have retired in the year 2000. By the time that 2019 came along, 2018, my portfolio was negative. I couldn't have retired like this. This would have been impossible to retire. I would have had a -$36,000. I'm living in debt. I'm living in debt at this point. I can't live like this. What happened? What happened? My plan was so good at the beginning at 6% withdrawal. And now it's horrendous. I'm living on debt. But I'm living debt. I'm living on debt. Let's see. You're catching some very real and very important, and it's not failing your plan. It's the harsh reality of sequence of return risk. Let's break it down. You didn't just have a few bad years. You had the worst possible start. If you had retired in 1997, your first 3 years were incredible. 33%, 28%, 21%. You built up a huge cushion before the dot-com crash. But if you retired in 2000, you walked directly into this. 2000, -9, -11.9, -22.1. That's -36% total in the first 3 years. Oh my gosh, it's awful. Plus, I'm withdrawing money. I'm selling at the bottom. I'm selling low. I'm doing exactly what you shouldn't do. So it's not just what average return you get. It's when you get it. That's the key. When markets crash early in retirement, you sell shares at low prices to fund expenses. Your portfolio shrinks fast. Later, gains have less capital to compound on. even though the long-term average return might still be 10%, your actual retirement trajectory depends heavily on those first few years. Wow. So when I retire really matters the most. I could have $1 million at the age of 32, but then the market immediately crashes and I'm screwed. But if I have $1 million at 32 and the market just goes up for 3 straight years and then starts to crash like we saw from 97 to 2002, I'm still golden. I was able to retire at 32. So it really mattered when I retire. And unfortunately, nobody can see when the market or like what the market's going to do. The good news is this is exactly why you're running simulations now, blah, 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 blah. But here's one thing that I also would like to point out is whenever the market went from negative returns from 2000, 2001, and 2002, that was a killer time in history, like 2 portfolios. It was literally killing retirement plans. And there was the dot-com bubble, there was 9/11, there were a lot of corporate scandals like Enron and WorldCom, which just kept that recession going for 3 years. And that's the only time in stock market history where the market returned negative returns for 3 years straight. It's never happened like that except for then. So really, if I would have retired at the year 2000, there was, out of all the years to retire over the past 100 years, there was a 1 in 100 chance that happened to me. And I'm sure it happened to somebody. Somebody retired out there in the year 2000. I shouldn't be laughing, but it's awful. It could happen. So I'm kind of curious though, like I like my 6% plan, but I saw it get decimated by 2002 run. If I would retire anytime but then, I think my plan works, right? I'm pretty sure it does. Exactly, you nailed it. Your plan isn't broken, it's actually very strong. You just picked the single worst moment in modern history to start. Why 2000, 2002 was a retirement killer? Yeah, so everything I mentioned, deep losses, blah, blah, blah. But any other starting point, let's look at rough alternatives. Any other starting point, 95, 97, 2023, 2009, 2010, 2020, 2022. Your plan works almost every other time in history, and most of those times you end up richer year after year, even while spending 60K. So what's the takeaway? My 6% plan works in 95% of scenarios. It only fails if the market tanks early and you keep spending without adjusting. And just one of these, and it likely survives even 2000. A buffer, which I had the first year's worth of expenses, lower spending during crashes, a small side income, delaying a year or 2 retirement. So really, even if I were to have retired in the year 2000, and then I had spent all my $60,000, my second year, I'm still retired, the market's still crashing, things aren't looking better. If I'm retiring at 32 years old, chances are I can still go out and get a job. I mean, worst case scenario, I can go pick up an hourly job and get, I don't know, $20,000, $30,000, $40,000 the first year. I think I can get even more than an hourly job though. There's a reason I'd be able to retire early. It's because I've been earning good money. I have good skills. I have a high skill set, a valuable skill set. So I could always go and get another job. Even if it's not like I retired in 2000 and then I say that's it, I can never work again. And whatever the market does, I'm screwed or I'm blessed by the market gods forever. Again, as chat mentioned, I could just reduce my expenses when I see things aren't going very well and I'm in my first couple years of retirement. But overall, I don't want to get too down the rabbit hole on this like 4% versus 6% versus 10%, how much we need to retire. I really just wanted to see, was ChatGPT good for financial advice and kind of running through simulations? And I think it was phenomenal. So if you're curious if ChatGPT's a good financial tool for you, definitely put it in your workbox. I love this. I've actually been using it a lot and I'm going to continue using it. So that's that. If you like this video, hit that subscribe button. Be sure to hit that like button if you made it this far because you definitely liked it, and I will see you later.